Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shad here, your hosts for this weekend's edition, also your hosts on our website, podcast, YouTube channel, and Substack page. Covering the market moves this week, a lot of focus on precious metals as well as company updates. A lot of companies, especially in the metals market, doing a lot right now. A lot of money has been raised, a lot of work ongoing, and a lot of positive share price action. We're going to spend quite a bit of time on this weekend show on the precious metals, especially in the first half of the show, as we're chatting with Axel Merk. Axel is the president and chief investment officer of Merk Investments, also manages the ASA fund. Now, Axel, let's start off with precious metals market overview. Last time we had you on the show was back tail end of May. Now it's September, and boy, oh boy, the precious metals are off to a very fast start in September. And that's after a fairly long consolidation of gold, about a 5-month consolidation where gold, it looks like now, really just consolidated a lot of those recent gains and now has broken out to higher levels. Well, give us your overview of what you're seeing in the precious metals markets, please.
Yeah, great to be with you. Indeed, gold had been in a range for much of the year, and in recent weeks it started to break out. Money is flowing into the big miners. And as you and some of your listeners are aware, we focus more on the small ones, and they've been keeping up for the most part. But as many of your listeners know, historically, they tend to have a higher beta and tend to move more with a lag. And I am not allowed to make firm predictions of what's going to happen, but if history is any guide, we haven't seen anything yet as far as the dynamics in this space are concerned. And it's really stunning. What particularly stunned me earlier in the week, we had a so-called risk-off day with the stock market going down, but the bonds, rather than rising, they fell, and gold reached all-time highs. And when the bonds are falling and gold surging, it means that this is different. And it's mostly different in other parts of the world where the markets aren't as robust, but also in the US. I mean, I had a chat just yesterday, and they said, all the things I've been talking about over the years are seeming to pan out. I said, yeah, no kidding. Things are happening here. And so this seems like it's a very eerie environment, and not too eerie maybe to the gold bugs out there, but it's a very special time we live in.
Well, Axel, to the point you just made, there's been a number of people on the show we've talked to over the years that have mentioned that at one point the bond bubble would burst, which it looks like it did back in 2020 when rates got all the way down to about 0.4%. And they've continued to rise since then, which means bonds have been selling off. And they said there'd be a rotation out of bonds and into gold as a safer haven. Do you think that's what's playing out here based on your comments, that there's money rotating out of the bond market maybe for good and going into precious metals?
Well, the reason I hesitate to say yes is simply because the bond market is just orders of magnitudes larger than the precious metals market. And so while, yes, money is more reluctant to be in bonds and gold is but one of the beneficiaries, I cannot go as far as saying the money is moving from bonds to gold, simply because the gold space isn't large enough for that, to absorb that. Now, obviously, that's part of the reason why the returns are disproportionately higher, but still the orders of magnitude are just dramatically different. And of course, at the same time, right, while bond yields have been moving higher, we are far away from the markets having lost complete confidence or anything like that. If you look at longer term metrics in the yield curve, inflation expectations are still contained and whatnot. So in many ways, to me, these are kind of canary in the coal mine type of things where the market is taking notice, but this isn't a fully fledged flight yet. And I'm not saying it's going to happen tomorrow, but there are markets like the UK where it's truly concerning what happens to the gilts there. And I wouldn't rule out that some shocks could happen in the US as well. I guess for the time being, it feels good. But keep in mind, when the gold investor feels really good, it's really normally not a very happy time around us. And I've been telling people that usually when we do well, we have a very counter-cyclical business, then others don't do so well. And of course, so far, even though the stock market is a bit down from the highs, most stock investors are just fine year to date.
You are right. The markets have continued to move higher, but metals have actually outperformed the markets. And I want to talk to you about the makeup of this bull market because, quite frankly, it seems textbook. Gold was running. Everyone was complaining that the gold stocks were lagging, but then the higher quality gold stocks, those started to play some catch up. Those were outperforming the companies that were, let's say, acquiring mines, building mines in production. Those were getting more love. And then, as the gold price flatlined for those last 5 months, the gold stocks kept running. And then we saw that move into the juniors over the last, let's say, month, maximum 2 months. And the juniors have pretty much across the board revalued. And now, as we started September, gold's making another leg higher. And it seems like all the equities are also following along, if not slightly outperforming right now. How does this fit into the overall history of how bull markets work for precious metals?
Well, it's history rhymes, right? And the one thing you didn't mention, but is somewhat implied here, the expectation of the Federal Reserve cutting rates, the expectations of the economy slowing down and whatnot are there. And that said, the Fed has been pushing out this time on when they're going to cut further. And recently looked at a chart from a year ago about where expectations were about now. And then we've kind of been pushing out that boundary. Now, keep in mind that the markets react about what might happen, not what actually does happen. And so this idea of cutting rates being pushed in front of us is helpful to the precious metals. And of course, it's anybody's guess of how this economy is going to do. I think most people would agree that the Federal Reserve is somewhat on the tight side. They're going to come off a little bit of that, but are we going to get into this recession that everybody has been forecasting forever, or is there going to be a push on deregulation and other things that kind of get us to be more booming in the economy? And I think the jury's out on that. And depending on the week we look at the markets, reasonable people will have a different assessment. The other way, though, to look at it is simply look at the action of the price of gold and saying, yep, the gold investor clearly thinks his economy is slowing down. And obviously, this is all in the context on pressures on the Fed to be a bit more on the easing side. And so the other thing to keep in mind is that this market, the gold market, can really move very, very significantly. And $50 in the price of gold isn't what it used to be at 3,500 versus at 2,000, right?
Well, actually, you make some great points, and there's really just a lot. It's a dynamic market, gold. There's so many forces at work. It's monetary policy from the central banks. It's fiscal policy from the governments and record amounts of debt. It's geopolitics. It's become almost a momentum trade this year, which is strange for the uncurrency that is gold. But when you look at the gold stocks, just thinking about what they're pulling out of the ground and what their margins are, the gold producers have had one heck of a run starting in Q4 of last year. But then first quarter, second quarter, great results, record margins, record revenues, lots of ways to return value to shareholder through share buybacks and dividends and acquisitions. Q3, we're almost most of the way through it now. Do you think that they're fully priced in as far as the moves from generalist investors, or do you think they are now showing up on more generalist investors' radars just because of their earnings potential and their performance this year?
Well, ounces in the ground are clearly not valued as highly as they used to be, certainly not given the price of gold. Investors in gold miners have just gotten burned so many times that they don't quite believe it yet, that this is an excellent environment for the miners. Keep in mind that unlike the previous bull market, costs are reasonably contained. Historically, when the price of gold goes up, many other commodities go higher as well. The cost of energy is very high, a huge component in the cost of mining. Also, the labor costs are moving higher. Governments want to have a bigger share of the revenue. And of course, we see some governments that want to take a bigger stake and whatnot. But overall, the cost pressures are very, very contained. Also, when the price of gold moves that quickly as it's down now down in recent weeks, it really goes to the bottom line. And the question is really, how is that priced into the stocks? And while of course these miners have gone up significantly, the margin expansion in some of these miners are quite substantial. And so I do think it takes a while for the generalist investor to wake up to that. It's part of the reason why we've seen flow into the majors. I still think that this doesn't have the signs of a late stage rally, and part of that is we haven't seen the crazy merge activity. Now we have some important conferences coming up. Maybe some things are getting announced. We'll have to see at valuations at these things, and the juniors historically at some point have some explosive rally higher, and I can't make a prediction that that will indeed happen, but historically that has happened not too infrequently.
I find this concept of what'll bring the generalists or the tech investors or the Bitcoin investors into the sector so interesting because I feel like we've always been talking about this throughout the last at least decade. But back in, let's say, 2011, 2012, when more commercials were out there, more people were talking about precious metals, there also weren't quite as many sectors to garner that attention. But I also believe that the majors need to show some leadership here because, quite frankly, their numbers have gotten a lot better simply because the metals price has gone higher. They haven't increased production. Yes, their costs are a bit more under control, which is good because a couple of years ago they were getting a bit out of control with some of their costs, but they can't control that. But then these stocks also aren't paying money back that much. Their dividend yields are 1%, 2%. So they're not income stocks either. You mentioned the potential of M&A. I would love to see more M&A. I'd love to see some of these big companies go out there and acquire assets, get some money rotating within the sector, even get some more of their shares out there in some of these other smaller companies' hands. What do you think these majors can do, or is there anything they can do proactively to bring investors in rather than simply sit back, produce the same amount of gold that they did last year, make more money because the price is higher, but then not do anything with it?
You mentioned many topics, so let me try to cover that next 20 hours here. The majors are completely underinvested and have shifted now to these large copper gold projects that take forever and have many execution risks, including the jurisdictions they're active in. They benefit, of course, from the higher price of gold, but I think they have many challenges. I don't see them being actively acquiring smaller players, mostly because they're too large. So I think that much of the M&A activity is going to be amongst the mid-tier and amongst the smaller ones, building new, larger companies. The other topic you mentioned about the Bitcoin investor and whatnot, I have, and I've gotten the ire from some Bitcoin investors. I've said that Bitcoin still wants to decide what it wants to be when it grows up. And what I mean with that is Bitcoin is quite correlated with risk assets, as are most of these cryptocurrencies. And so while they do have a little bit of momentum on their own, maybe it's because of the lack of maturity in that space. It's different from the price of gold that has a history of being uncorrelated. And so Bitcoin, when the S&P doesn't do well, might not do well. And at the same time, the Bitcoin investor, a lot of them are speculators. And so if we have a protracted rally, I wouldn't be surprised if those crypto investors jump into gold. Some of them are loyal to Bitcoin, but most of them just want to make a buck and be momentum investors. And part of the reason why gold has had quite a nice run for quite a while is because we've had few of these speculators. And if gold can attract a speculator again in volume, that of course may be good in the short term, but it will certainly also increase volatility. And so the dynamics may well change here going forward if this rally continues for an extended period.
Well, Axel, one element of the precious metal sector that does get more of that speculative bid is silver and the silver equity. So I'd love to weave in the lesser precious metal that's also a hybrid metal, part industrial. Poor man's gold is starting to play catch up to gold, but obviously has not broken its 1980 or 2011 high at $50 yet. But hey, we're above $40 this week. We're above 42 as we record this on the futures market. So what do you make of silver and the more speculative bid that it gets sometimes?
Well, silver has more industrial use, and as such, it is more subject to the whims of the economy. And so, if the glass is half empty on economic growth, silver will be held back. But at the same time, it is much more volatile than gold is, or can be at least. And obviously, as I talk here on my screen, they're exactly to the second decimal, the same move for today. But silver is historically more volatile, and silver is the sort of thing that yes can be very very frustrating to watch, and then it moves higher, and then just as you celebrate it, it plunges again, and then you're waiting for the next move higher. So it's not for the faint of heart. Gold is plenty volatile for me, but sure, if you expect the price of gold to move higher, you have more volatility in silver, and for the right type of investor, that could be of interest. On the mining side, there are not many larger publicly traded high quality silver mines. Silver tends to be a byproduct, and there are some private mines that are attractive in my assessment, but it's just much more difficult to invest in on the mining side.
Okay, let's get back to the underlying equities now because, as I said, it does seem like the sector's gone through a revaluation, but you also made the comment that ounces in the ground are still not being valued at the value that they have been historically. Let's focus on those companies then. There are a lot of companies out there right now with resources all around the world, and a lot of gold companies with, let's say, over 1 million ounces. That was the holy grail a decade plus ago, but now a lot of these companies have been around for a while. These projects have been around for a while. They've built up resources. What do you focus on when you're looking at these companies with resources in the ground that would separate them from the rest of the pack?
Well, it's the management teams, of course, and the in the current environment, it's easier to raise money. You want to bet on management teams that, when times aren't as great, can raise money as well for the next phase in their project that are able to execute. But you're right. I mean, there are several companies there that are in the sweet spot right now. And the nice thing about these smaller companies is they have catalysts that go beyond just the price appreciation. As these companies go further in the development phase, they tend to get a higher multiple, they get higher valuations as they get added to indices and so forth. And what we do, we have somewhat of a venture capital light approach. I mean, we like to brag about the winners, but of course, not all of them succeed. And if you, just like on the venture capital side, if you bet on the good management teams, you're stacking the odds in your favor. The other thing you want to do is you want to look at who are the providers of capital, and are those the sort of folks who are likely to be around when these companies need to go back to the market for the next round of funding? And so if those things are in place and the price is in place, yes, I think there are some very attractive opportunities out there.
Well, Axel, in the stepping down from the producers into the companies that are development stage, the developers have projects that they put out these different phases of studies on the PEA, the PFS, and the FS, the preliminary economic assessment, the pre-feasibility study, and the feasibility study. They get more and more de-risk as they go. But when you look at the net present value of some of their assumptions, a lot of them are still using the gold price of $1,800, $2,000. Some have jumped it up to 2,400, but obviously we're at $3,600 on the futures price. So do you think that there's a lagging factor in how these developers are being rated by the marketplace because people are just not seeing how they translate in today's dollars?
Yes, that's the short answer. And one of the things I like to watch is how are these valuations or these estimates increased. And we have these big conferences coming up, and I'll be keen to hear about whether the companies get more optimistic. The important thing, of course, as a producer is that you have your costs under control. And if you need to push up the price of gold in order to be profitable, that's a red flag. And so I kind of like it when they keep those cost estimates low, especially if the cost of gold estimates low, especially if the cost of building the mine is somewhat stable as well, because obviously it goes all to the bottom line. And that's, yes, that's where the value is, of course, right? And many analysts on the street are reluctant to move up with their estimates, and I'm perfectly fine with that. I'm very happy when there's quote unquote good value, if one can talk about that in this very volatile space. If everybody was chasing the price of gold, I'd be much more concerned and probably be running for the hills.
Now, actually, you also mentioned the financing environment. We just got through a summer, and It was a very busy summer, especially considering what we've been through the last number of years, especially on the financing front. So many junior companies in the last 2 months have raised large amounts of money. These are the same companies that we were talking to at the beginning of the year at some conferences in Vancouver saying that they couldn't even bring in $1 or $2 million through the door. They've raised five, six, $7 million, now have much larger work programs. Have you ever seen a financing environment that we are, it seems like, still currently in with how much money has been raised, especially in the small companies?
Yes, I don't think there is a speculative frenzy at this stage. And obviously, to be, I reserve my judgment, right? I reserve my judgment to change my mind on that. But I don't see that people are giving things at valuations that are ridiculous or whatever it is. If that were to happen, I'd be far more cautious. The funding window can be open for years or it can be open very briefly. And of course, the companies don't know, so they're trying to seize the opportunity. But I continue to see quite a bit of discipline for the most part, right? I mean, there are of course exceptions, but and clearly a bull market will give funding to projects that might not succeed at the end of the day. But I am, at this stage at least, not concerned. But we're clearly in a different environment than we were even half a year ago and certainly a year ago.
Well, Axel, another ways that companies have been able to utilize capital has been accessing the sale of royalties or streams on their properties to the royalty and streaming companies. I believe you follow a lot of these companies in your work, and I just was curious what you thought of the role or the evolving role of royalty and streaming companies in the business and as an asset class of their own.
Well, you talk about evolving. What I've seen is that some crypto companies have taken an interest in these royalty companies, and so that's of course interesting if they try to repackage this thing at some point into some blockchain technology. I'm an observer on that side more than anything else, and I can't say I'm the expert in that, but it's certainly interesting to see that there's keen interest that goes beyond the traditional investor.
Yeah, what a change that has been. Hey, and I'm with you. I'm curious to see how these crypto companies package it into some sort of stable coin, what have you, to potentially truly open up that other market or the crypto market. What about, let's say, the bottom of the food chain? Hate to say it, but the explorers, the ones that don't have resources yet, the ones that now have money and are out there exploring projects. How are you viewing those companies?
Maybe we've just been too busy with developers. A few months ago, my answer would have been that you can get the developers cheaper than putting the money into the explorers and helping them develop them. And my portfolio managers have not come to me and with fantastic ideas about explorers. So if you have them, bring them our way, and we'll explore the explorers, I suppose.
What characteristics are you looking for in explorers? How about you answer that one for me?
Yes. Well, it's we invest in management teams. That's the very short answer, right? Give us the best management teams, and we can allocate some money to it. That's the short answer. And of course, there's some due diligence to be done and whatnot. But we've moved a little bit up from the explorers to developers, and I can't say whether that's a quality assessment. It's just that where we are right now, maybe it's just also because this bull market has pushed up to us to be a little bit larger. And while we still invest in very small companies, there are things that are too small for us. And so I'll just leave it at that. I can't dive into too many specifics, unfortunately.
Well, Axel, just to follow up on that, there's about 1,000 exploration companies out there across different exchanges, whether it's in the TSXV, on the CSE, or even in the US. Then there's all the Aussie listed ones. And we just went through how the developers weren't getting the kind of valuation they have in the past. And there's a lot of choices. And Corey mentioned there's a lot of companies that have way more than 1 million ounces now. How many more exploration companies do we actually need when we have so many projects out there still sitting on the sales rack?
Well, Earth has not provided us with enough gold in the ground to satisfy all the demand out there. I mean, that's the short answer. There is a limited supply of gold, and the good news is, regardless of whether these projects are successful or not, especially if they're not successful, the gold is still in the ground, right? And maybe at some point the right management team will be able to get it out of the ground. But yes, I mean, if you can get it out if you can get the developer at a better valuation, relatively speaking, then might as well go for the developer. But that doesn't mean that there aren't some fantastic nuggets out there.
So, Axel, look, it sounds like we are all in agreement. This is a bull market. That's undeniable. The stocks are joining in. It's a momentum trade. A lot is going in favor of gold, but we constantly hear people predicting what inning of this bull market we're in. I think that is simply a marketing tool because a lot of people usually say it's early innings, no matter what stage we're in. I like to ask people what we should be watching out for to give us a bit of a sign that the market might be topping and it might be a good time to clear out some of our positions, lock in some of those gains. What are the characteristics you're going to be looking for that would be, in a sense, a potential bell ringing of a top?
Well, first of all, the price having moved up that much that quickly means it could also move down that much that quickly. That's not my baseline, but from a risk point of view, investors must be willing to bear that risk. It's just, this is not a safe space. It is a speculative space. Otherwise, I'm looking for deals where people overpay. I'm looking for the sort of things you asked about, right? Whether the estimates for the modeling is going to go revised upward substantially, or whether they will be conservative, whether companies will lose discipline on things, whether management teams that are not good are getting substantial amount of funding. That's the sort of thing I'm looking at. The mere fact that the funding window is open and that these valuations have come up in the backdrop of a higher price of gold, right? Let's keep in mind it's been with a huge lag. Price of gold has been higher for an extended period, and at least in my book, the juniors still haven't caught up as much as I think they should, based on where the price of gold is. So that said, I'm of course somewhat biased because I'm in the space, and so take it for what it's worth. But the majors, they also continue to be quite disciplined. I don't expect that to change too quickly because they're really busy with their mammoth projects. We'll see whether this discipline erodes in the mid-tier space or elsewhere. Keep in mind, the selling company always wants to have, of course, a very high price. And so we'll have to see. We are obviously not in the early innings anymore because this is a bull market. We've had the early innings for a very, very long time. But I don't think we're in the late innings yet.
All right, Axel, we will wrap it up here. Again, Axel Merk is the Chief Investment Officer at Merk Investments. If you want to learn more about his firm, visit our website, podcast, or YouTube page. Check out this posting and click the link in the show notes. Everyone, stick around. We are going to be right back, switching our focus a little bit more to the broad averages, where opportunities lie within the commodities, but also in other sectors.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Hope everybody enjoyed those first two segments with Axel Merk. Yes, we focused a whole lot on the precious metals, so now it's time to take a little step back and look broad markets. Also, look at what kind of the technical setup is for the metals markets, as we're now chatting with Dana Lyons. Dana is a fund manager and the editor of the Lyons Share Pro website. Special offer that Dana is extending to all of you, our listeners, 30% off if you sign up at the Lyons Share Pro. Because this offer is being extended to just all of you, you need to email either Dana or I, and I will forward that email on to Dana, put you in touch with him. And if you're an active trader out there, which I know a lot of you are, great opportunity to follow along with Dana, who trades a wide range of markets, as you're going to hear. As we always talk about with Dana, let's start off with U.S. equity markets. We turned the calendar over to September, and the market started to fall, but that sure didn't last long as the markets were pretty quickly bought back up, and it just does seem like this buy-the-dip mentality persists. A lot of tech news that came out, especially around Google, that really went through a run this week, so Dana, big question is, what are you seeing in these markets? Have any of your models shifted away from that general bullish nature that we've been talking about?
Yeah, thanks, Corey. Not really, not in any meaningful way at this point. We've had some wavering in several of the components of our main risk model, which has been bullish since late April. But there's been some wavering, below the surface, but not enough to really move the needle. I think right now, as you mentioned, we've had such big moves off of those correction lows in April that a little digestion is certainly warranted at this point. I think we discussed the last time I was on. You have some overbought indicators, you have some technical resistance as far as some of the Fibonacci extension levels on the Nasdaq 100, the S&P 500. So you have some technical reasons to pause, and you also have, given the extent of the rally since April, you had sentiment that really flipped 180 from wildly bearish, wildly panicked sentiment at those lows, at those April lows, to pretty excessively bullish here over the last couple of weeks. So you have that sentiment that really needs to get worked off a little bit more. And on top of that, we are now squarely in the historically seasonally worst period of the year in terms of equity performance, being in September and then really the first half of October. So you have plenty of reasons to kind of take your foot off the gas and consolidate and breathe a little bit. But as far as any of our models really reversing and turning bearish, we're really not nowhere near that point at this point.
Well, Dana, I know one of the areas you like to look at is the relative strength at certain sectors. So underneath the hood of the general markets, are there any sectors in particular that you're more heavily weighted to or that you think are showing the best relative strength?
Yeah, as you know, we're really big advocates of relative strength and really concentrating our portfolios in those areas that are working best. Sometimes that's only a few sectors or relatively small handful of sectors or market segments. Sometimes you have a wide array of market segments that are performing well. And that's really been the case for most of this rally. You have really no shortage of areas that are performing well. So when that's the case, we do like to diversify, not among all sectors, but among all high relative strength sectors. So that has been kind of a luxury for us to have some money spread around from, technology to industrials to financials and even some of the defensive names, utilities, consumer staples at times. And then both domestic and internationally, we've seen, this year has probably been the best year internationally that we've seen in many years. So no shortage of targets out there, which it presents a constructive scenario for us in that when you ask what areas we're looking to overweight or are we overweight, we haven't seen a lot of sectors really fall by the wayside and give up that relative strength status. What we've seen is some leaders run into some resistance and then pause and have to consolidate for a bit, like we're seeing with technology. Had a huge run, major leader up into August. We expect it to continue to kind of consolidate and digest that leadership. And at the same time, we're seeing other areas of the market that have pulled back during that leadership, maybe like utilities, like I mentioned, consumer staples, some of those defensive names that had been at all-time highs have just now pulled back a little bit to some decent support levels. And we can kind of rotate some money into areas that we're taking profits from and then roll them into some areas that are maybe sitting at support and still, from a relative strength standpoint, in the intermediate term at least, still showing that good strength. And obviously, another group that we've been overweight and that has obviously been wildly leading the way in terms of relative strength has been the miners and the precious metals group. So we have been really heavily on board in those, and just in recent days really have been pulling our horns in a little bit, taking some profits and rolling those into other areas that really showing better entry points at this point.
All right, we'll get into maybe some more of those trading strategies around precious metals and the miners, but I do want to focus you back on those tech stocks. We just keep on hearing how this market's driven by tech. The large tech companies make up so much of the broad averages. They consume so much money in terms of earnings, and they're out there spending a lot of money. Google had news out this week from the potential breakup that wasn't a breakup. That stock moved higher. In terms of tech, and your view broadly on these major companies that sometimes are even looked at as safety plays because of the cash they have, but then they are also spending on growth. What's the trading strategy for big tech right now for you?
So right now, like I mentioned, really off of the lows, or at least since probably May, June, really got going. Nasdaq 100 tech really got back into gear. We had a nice breakout, I think late June, early July, really took over that leadership mantle again. We saw that nice comeback in semiconductors as well. But right now, like I mentioned, we have seen a bit of a run up into some fib extension levels, which present a good time for taking some profits, good impetus for some of these tech sectors, tech names to pause here for a little bit, consolidate perhaps during this seasonally difficult period of the year, September, October, and let things digest a little bit. Maybe they pull back towards those breakout areas. Maybe they retrace to some key fib retracement levels, what have you. But I don't see any reason that they can't, once this consolidation is over, why they can't continue higher and put in a new up leg and even take over that leadership mantle again. Right now, it's like I mentioned, probably a time to take the foot off the gas a little bit in those areas and maybe play some other names like the defensive names while you're waiting for some of that digestion to occur. So in the longer term or intermediate term, there's certainly no reason to turn bearish on those tech groups. But right now, like I said, in the short term, probably not really pressing an accelerator on those right now.
Well, Dana, I know that your models keep you from falling into the trap of looking at media headlines and narratives, but there is some rationale to the idea that if the Fed is going to be cutting interest rates, that's a bullish thing for the small caps. So the IWM is what I want to ask you about. And obviously, a cheaper cost of borrowing for these smaller, a lot of them pre-revenue companies, is a good thing. The IWM has been a laggard for a while, but it is starting to respond. How are you looking at the small caps?
Yeah, and we do have a handful of small cap names. We are long a small position in the Russell 2000, a leverage product in the Russell 2000, since it has been hitting new highs, at least for the rally, certainly lower highs versus last winter. Same thing with some of the other broad averages like the mid cap average, the value line geometric average. So median stock is really still a bit below the highs from last winter, which is certainly not ideal, but we have seen other broad averages, including the NYSE advanced decline line, hit new highs. We've seen the Valuation arithmetic average, which tracks the average stock, that did hit new highs. We're seeing the S&P 500 equal weight average did hit new highs. So some of the broad averages, we're seeing good growth. Specifically the small caps, a couple areas within the small cap space that we do like. One is a dividend play that we've been in for really a couple of years that has been hitting new highs. That's been a good play and plays into maybe that theme of rate cuts, because we also have other dividend plays that have been doing well. A technology dividend play that's been holding up really well. And then you look at maybe the utilities, some of these income proxies that should do well into a rate cut, and maybe a harbinger, the performance might be a harbinger of that rate cut to come. So I do think I do buy into your narrative, even though we have to see it play out on the charts and in the data. I think it is starting to play out. One other small cap space that we do like to key in on it, as historically it's been, at least among the style groups, it's been probably the best indicator of risk on, risk off. It's an index called the Small Cap Pure Value Index. And generally, when that's leading the way, risk on is in gear and vice versa. And we have seen, especially over the last maybe month or so, we have seen a huge move upward in that small cap pure value index, and all the way up to test those highs from about a year ago or last winter. So I would say that is another good perhaps harbinger of an eventual breakout, another strong up move to this bull market. Once any seasonal sentiment working off has to be done here over the next couple months. We are seeing good signs in some of those broad averages, some of those risk on averages that indicate eventually here we should be able to again break out and put in a new up leg.
So since you mentioned some of the dividend stocks, we don't usually focus on these income stocks. We are focused on those stocks where the price is moving up, not really caring about what the dividend or income might be, but lower interest rate environment does make people think they need to find some sort of income stocks. And quite frankly, that there are a number of investors out there that like to stick to the dividend, what you would think would sometimes be safer stocks. But where do you invest, or what areas of dividend stocks have your most attention then?
Well, dividend stocks that have been moving up. So again, all of our investment selection ideas from our relative strength models. So we have seen a number of dividend plays. One of the small mid-cap dividend play that we've been in is SDVY. Been in that for a while. That's been hitting new highs, at least for the rally. That's been a strong performer. Then the technology dividend play that I mentioned, TDIV, has been a leader. Really, we've been on that for years. That had a strong breakout several months ago and has been really a nice tight consolidation over the last couple months, really priming itself for another breakout and a new up leg there. So those are just a couple examples of it, but I find it interesting. A lot of the income proxies have been pretty good performers, at least over the last couple months, maybe giving you an indication of what I guess most people are baking in right now, which is a start of a rate cut cycle this month.
Well, Dana, you also mentioned that this has been an outsized year for international stocks, and it's a big world out there. So if you were going to narrow it down to just a handful or a couple that really have your attention, which international ETFs or areas are you most interested in investing in?
Yeah, it's hard to narrow it down because there have been so many good plays from Europe, which really led the way off of the move in off of the lows in April and it's been consolidating for a bit now. That I think there's going to be another good up move coming there. You've had some sporadic emerging market names. Most recently, we've been heavily invested in Peru, which is still on a bit of a heater right now, which has been nice to see. Argentina's kind of fallen off, so we've kind of rotated some from Argentina into Peru. But I think the one international market right now that has probably our most attention outside of Japan, which we've talked about, but one market we're looking at, and we've started to leg in a little bit as we've been looking for opportunities in areas that haven't moved as much yet, while the rest of the U.S. market kind of consolidates, and that's China. We've seen a nice rebound in China, which has lagged for a long time. For a couple of years, it's been banging against some highs, but not able to break out. We've just seen a recent breakout to new rally highs, multi-year highs in a lot of the Chinese ETFs. And what is attractive there is that we're seeing really new emerging relative strength there, no pun intended, while, like I mentioned, some of the U.S. and other international markets did get a bit overbought and need to get worked off. There's still, I think, plenty of fuel to go behind some of these Chinese names. So that if I was looking for a place to allocate, like in the immediate term, that is certainly one market I'd be looking at.
Let's also talk bond markets because rate cuts are coming. Bond markets have been relatively boring and kind of different. So we see the 30-year, that's hanging around some of the recent highs of the last couple of years. The 10-year, very much a mixed bag, really trading in the middle of its range over the last 3 to 4 years. Little bit of money flowing into some of the bond market, especially on the short end, probably mostly around what's coming from the Fed, that being a rate cut. But it can also be a sign of some sort of a defensive play. But I think questions are starting to be asked on if U.S. bonds are truly being looked at as a safe haven. You seeing any key moves or any changes in the bond market in the U.S.?
I'm seeing the same thing you're seeing, which is really no movement over the last couple of years. We've seen yields move sideways, which, like we've seen recently in gold, you have big moves up and then really very little give back. You've seen long consolidation. Those tend to be more continuation moves. So I would expect eventually, and we've talked about this for many years, we think the long 60-year cycle in interest rates bottomed in 2020 at COVID, and we think they go up for several decades to come, most likely. Now, nothing goes in a straight line. So, in the near term, would pullback or retracement in yields surprise me? No, not in the least. Would not be surprised to see that. But I think in the long term, I think yields go much, much higher. In the short term, I don't see any compelling reason to be long or short any of these plays right now, with yields pretty much, again, going sideways for the last 3 years or so, and pretty much get really right in the middle of the range. So I don't, again, I need a compelling reason to put my money to work, to put our clients' money to work. And I don't really see that in the bond market right now.
Well, Dana, in passing there, you referenced gold, so we got to go there. Gold punched up above $3,600 an ounce. I know you usually look at GLD, but then also the gold equities breaking out levels they've not seen in about 14 years. GDX, GXJ, any thoughts on gold and the gold stocks?
Yeah, I mean, if it ain't broke, don't fix it, right? So, like we've been talking about, really, it's been going on for years now. I was looking at the chart the other day, and I recall back in, the probably 2022, 2023, how we were discussing what looks like a long-term cup and handle setting up in the price of gold. And indeed, we did get that big breakout in early 2024, which set the stage for what we thought would be a huge move. Well, guess what? 2 years, almost, well, a year and a half later, I guess, we've gotten that huge move. Now, there's no reason to turn bearish just because we've rallied so much. But at the same point in time, after that type of move, I know the tendency for investors to get more bullish the more prices rise, and vice versa. I would tend to get not necessarily bearish the more prices rise, but certainly less apt to put new money to work there, and instead really start taking some profits. So, like I mentioned, GLD specifically, after that, if you rewind to that bear market from 2011 to 2016, about that 261 fib extension brings GLE up to about 325 or so, which is a bit basically where we are now. So we've taken a little bit off the table. We'll ride with most of our positions, but and then the same thing goes for it. It's not exactly the same because we haven't seen new breakouts to all-time highs in the gold miner plays, the gold miner funds. So certainly, if we got breakouts to new highs in those names, that would open up even more room to the upside. If it's going to catch up to the price of gold, not sure if it will or not, but certainly it would open up further upside if there was going to be some catch up. But right now, GDX, for example, really approaching those all-time highs from 2011. So it's been a heck of a run. Again, I would be really less apt to put new money to work here in the gold equities, even though I'm certainly not bearish by any means. But, up around 67, a test of those 2011 highs, I would be banking some profits there for sure.
So, Dana, earlier this week, we had another technical trader on the show, and he was pointing to just how overbought gold was, even the gold miners, and also some breadth indicators that just show how stretched some of these mining stocks are. A lot of these mining stocks are at 52-week highs, many at all-time highs, many at least 2 or 3x off of some recent bottoms. How much do the overbought type of scenario, type of characteristic play into your models, and how do you trade around that sort of environment, which means it's a bull market, but overbought sometimes means that it needs a cooling off period?
Right. Usually the momentum type indicators don't gear us out or get us in, to be honest, because overbought can stay overbought for a while. So, like, for example, right now, yes, the metals and the miners are certainly wildly overbought, but like I said, It doesn't mean I'm getting bearish on those. It doesn't mean I'm, jumping ship by any means, but I will take some profits and here and there. And I'm certainly not looking to press the pedal down when we are this overbought. But typically, when you get this overbought, there will be some sort of divergence in those momentum type indicators before a permanent top or a long-term meaningful top is in place. So I wouldn't be necessarily dissuaded from being in those securities just because they are overbought. But I'd be certainly have one eye, not necessarily on the exit, but one eye certainly out for any divergences in the terms of those momentum indicators. So again, the trend is your friend. And when you get these types of moves, they talk about how dangerous bubbles are, but the upside of bubbles are great. So you want to continue to ride those. But when you get maybe some early indicators like some divergences, some lack of confirmations, either in the breath stats or potentially in some of those momentum indicators, that could be an early heads up of, okay, maybe there's momentum waning here and it might be time to at least book a little bit of partial profits.
Well, Dana, let's also work silver in. We always lump silver in with gold, but they're really two different asset classes, and silver's chart's different than gold's, and it's not at a new all-time high yet. It hasn't even broken its $50 all-time high from 2011 and 1980, but it's been in momentum, and it broke above $40 an ounce, and it's up in the 41, 42 range. We haven't seen that in 14 years since 2011. So how are you looking at silver as its own momentum play here?
Yeah, again, really, the long-term chart kind of looks different, certainly, than gold, but we've been on board with these, like we've discussed for, the last couple of years. Silver's been strong since really the beginning of 2024 when gold was really always the leader and silver was kind of always the runner-up there. Then you had the platinum and copper that have really, especially platinum of late, have really played some catch up. But you had silver has had some technical, victories along the way, not on pace with gold, but you saw a nice, at least local breakout back in early 2024, and that started the recent move. And I think the breakout we had earlier, a couple months ago, maybe it's June or July in silver, really it was a springboard to this recent run that we've had in both silver as well as the silver miners. So I would say same thing as gold in terms of just riding the trend, riding the momentum. But if you have, for example, looking at fib extension levels to new highs in gold, if you have some fib retracement levels, and for example, SLV that we trade, I'd be looking to take some partial profits at that point. So right now, looking at just about $40 on SLV, I'd be looking to take some profits in that one. Doesn't mean we can't get back in if we pull back to some support levels, but that's really the point of taking some profits is obviously, especially in the miners over the years, we've seen just wild swings, big spikes higher and then immediate, rug pulls from out from underneath them. And if you don't take some partial profits into those windfall moves higher, it's easy to lose all those gains. So I would just say, don't be afraid to book some profits. You can buy it back on pullbacks, but just beware of getting, building up too much FOMO and the temptation to chase because, like I mentioned, the more prices rise, the more bullish people get, or the more bullish some investors get. And I've never seen, at least in a long time, I haven't seen this many headlines about how much, upside precious metals have, and including the miners right now. And when you're seeing such an abundance of headlines and promotions, I would say that should send off a little bit of alarm bells that at least avoid chasing. Look to pick your spots, but certainly those are more end of the move type of indicators than they are certainly at the beginning of the move.
That's a very good point, and interesting to hear that you are seeing those headlines as well. What about any other commodity or resource sectors? Most have been fairly slow. Copper had some news a couple months ago, but now it's broadly just back in its trading range. Oil's done nothing. Nat gas has been kind of boring in itself. Anything else in the commodity space that has your attention?
I think platinum, like I mentioned, platinum has been a really good performer. We've seen the ETFs approaching all-time highs again. Those should be able to set up new up moves after consolidation here. And copper, after, obviously got slammed into the tariff news, I guess, end of July, early August. It did was able to hold support right after that move. So we did buy into that and especially bought into some of the copper miners, which really got taken out into that move. And the copper miners especially have bounced back nicely. Also approaching their old highs in terms of COPX, which, book profits on the test of the highs that the junior copper miners, COPJ, have bounced all the way back to hit new highs. So that's one I would continue to run with and really leading the way in terms of the metal, whereas, some of the other metals have been leading the way versus the miners. Been kind of the opposite in terms of maybe copper right now. But like you mentioned, across the rest of the commodity space, I'm not seeing a ton, maybe seeing in terms of some of the grains, maybe corn, maybe the beginning of putting in some sort of a potential reversal or bottoming process, but still too early there to make any aggressive bets. But I think metals certainly has been where the action is, and will continue to follow that action as long as that trend continues.
Well, Dana, what about uranium? That's been one metal that has been performing since, at least since the April dip. From April to July, most of the sector's up. If you look at an ETF like URA or URNM, any thoughts on the uranium mining stocks?
Yeah, cause still like uranium a lot. We have no position in the miners right now, but URA, like you mentioned, had that brilliant run off of the April lows. Has really been consolidating here since, breaking out to new highs in, I guess, June. Really been going sideways over the last 3, 4 months, which, again, as I mentioned, when you get huge spikes up like that, when you get those quick retracements that take away, basically all of those gains, that's not what you want to see. But when you get a big spike up and you see prices hold firm, you see any retracements really remain shallow and see the consolidation nice high and tight, that is more indicative of a continuation move, a move that eventually should resolve to the upside and be able to put in another up leg to the bull market. So that's what we're looking for right now in terms of uranium URA. So we still have a healthy position on there, and we would expect again eventually upside resolution, a new up leg there.
All right, Dana, last area to talk about cryptocurrencies. Bitcoin was recently at all-time highs, then faded. Seems like it's making a bit of a comeback now, but still easily holding over that 100,000 level. A lot more action in Ethereum, so kind of moving down the food chain in the crypto space. Where are you seeing opportunities here?
Yeah, Bitcoin, as far as we're concerned, still hitting higher highs, higher lows. Yes, in the short term has pulled back, lost some initial levels for the 50-day average and whatnot. But I do see a good array of support down closer to that 100,000 level, like you mentioned. So I would be buying the dip down there. Also have a small position in Ethereum, but after the move it had, after the breakout it had in August, shot up to test all-time highs around just shy of that 5,000 level. Any pullback like we got a couple of weeks ago towards that 4,000, 4,100 level, I'd certainly be a buyer. We bought some a couple of weeks ago. If we get another chance down at that level, we'd be certainly be looking to add to our position. Again, there's another one that's been consolidating nicely after testing all-time highs. Could be setting up another upside resolution and new up leg there as well. So again, we'd be buyers down around that 4,000, 4,100 level.
All right, that's going to wrap up the weekend show. Dana, it's always great having you on the show to give us that more balanced perspective on a wide range of markets and what you're seeing, at least in terms of short-term trading. First half of the show was very much focused on precious metals, back half, very much just getting a big picture look at the direction of markets and whether this kind of bull market that seems to be in a lot of sectors is going to continue, and sounds like it might for the short term. Everyone, thanks for tuning in. Thanks for spending some of your weekend with us. If you're listening on the radio, be sure to visit our website, podcast, YouTube channel, or Substack page. to get all of our daily editorials, company updates, the notes on those, and to stay up to date with market moves. And as always, you can keep in touch with Shad and I through email. Send us emails. Let us know what you're looking at, the questions you want us to ask, and we'll be sure to relay those on in all of our interviews. So Dana, again, thank you very much for joining us. And remember, take advantage of Dana's special that he is extending to all of you by sending me or Dana an email. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.